Capital structure theories. Capital structure theories explore the relationship between capital structure and value of firm. It explains how financial leverage affects the value of firm in earning per share. 1. Net income approach, also known fixed KA theory. It is suggested by David Durant. He suggests capital structure decision as relevant to the value of firm. A change in financial leverage will lead to a corresponding change in overall cost of capital. Decrease in the financial leverage will cause an increase in cost of overall capital and decline in the value of firm and market price of shares. 2. Net operative income approach. It is also suggested by David Durant. In this approach, capital structure decision is irrelevant. Any change in financial leverage will not make any change in the value of firm. Overall capitalization remain constant. When leverage increases and decreases, no change in cost of overall capital and value because the risk of equity will also be increased, thereby they expect a higher rate of return. Neutralization, higher return trade-off by higher risk. Value equals EBIT divided by cost of capital. 3. Traditional approach. According to traditional approach, there exists an optimum capital structure for every firm. At optimal level, the overall cost of capital is minimized and the value of the firm is maximized. Beyond this limit, the increase in financial leverage will increase in cost of overall capital, and hence the value of firm will decline. Up to optimal level, the cost of overall capital decreases and value will increase. 4. Modigliani-Miller approach. Weighted average cost of capital is independent of its capital structure. Firm can't change its value and overall cost of capital through judicious mix of debt and equity. Value equals net operating income divided by cost of overall capital. The use of debt by the investor for arbitrage is called personal leverage, or home leverage. Proposition 1. Absence of tax. This proposition states that the overall cost of capital value of firm are independent of its capital structure. The total value of firm must be constant irrespective of the degree of leverage. The cost of capital as well as market price of shares must be same, regardless of the financing mix. The operational justification for this hypothesis is arbitration process. In the first phase, a levered firm may have higher market process, will drive the value of two firms equal. The value of the firm depends on investment decision. The arbitration process will bring both levered and unlevered firms equal. Proposition 2. Financial risk. It states that firm's cost of equity capital is a positive linear function of firm's capital structure. Cost of equity equals cost of overall capital is added with the sum of cost of overall capital minus cost of debt multiplied with debt by equity. It says that cost equity capital of a levered firm is equal to the overall cost of capital of an unlevered firm. With increasing leverage, the risk and return of shareholders increase. Leverage increased, the cost of equity also increased due to the financial risk of the equity holders. Proposition 3. Investment risk. It states that cut-off rate for investment purposes is completely independent of the way in which an investment is financed. Cut-off rate for investment is independent of the firm's financing choice, and it depends only on the risk of project in which investment is made. 5. Pecking order theory. Peck least risky security to most risky security. Most risky security equals equity. Capital raising is, first through retained earnings, if it is not available then finance through debt. Equity is the last resort for financing. This theory is based on the assertion that investors have less data about the firm than managers. This implies that firms should always use internal finance, that is, retained earnings if accessible, and choose debt over an equity issue if external funds are required.